When it comes to building wealth, it is not about how much money you earn. It is about how much you keep. And taxes are the single largest expense for most households. We spend more money on income tax, property tax, sales tax, and many other forms of taxes than we actually spend on our largest living expenses, from housing to transportation to the food that we put on our tables. So the question that I have for you today is, what is going to be your strategy to reduce your largest expense and keep more of your hard-earned money in 2025? We are now at the beginning of a new tax year, which means most people right now are starting from scratch when it comes to their tax strategy. So as a licensed CPA, I want to give you some tips that I personally use to help my clients save tens of thousands of dollars in taxes every day at mycpacoach.com. There are several moves you can make to take control of your taxes and keep more of your money. There are certain elections you can make to change how your income is taxed. There are certain investments you can make that qualify for huge tax deductions while preserving your wealth, and so much more. So let's go ahead and walk through this. All right, so let's start with some free and easy tips that cost you no money out of your pockets and can greatly reduce your taxes. Number one, managing your W-2 withholdings. So did you know that getting a big tax refund is not always a good thing? All that means is that you paid the government more money than you actually had to throughout the tax year. For example, if you received a $15,000 tax refund, that just means you paid the government $15,000 more than you actually had to throughout the course of the year. And guess what? While the government sits on that extra cash throughout the year, you earn zero interest on those funds while it sits in their bank account. I mean, just imagine having more money in your pockets throughout the year to invest or to put to work into a business venture that could actually increase your wealth and reduce your taxes instead of just depositing extra cash into the IRS's bank account just for them to turn around and wait a year or so to return that money to you with no added interest. So to address this, all you would have to do is carefully update your W-4 with your employer or through your business if you take a W-2 from it. And to help you do this, the IRS has a free withholding calculator on their website, which I'll link in the description, to prevent you from, quote, having too much or too little tax withheld from your paychecks. Now, on the flip side, if you typically owe more than $1,000 in taxes when you file your tax return, you may actually want to increase your W-2 withholdings to avoid penalties related to underpayment of your taxes. Now let's go over another tip that can help you change how your income is being taxed, which involves making tax elections. Now, this is another free tip that costs you nothing more than a choice that could end up saving you more money in taxes. Okay, so look, if you earn 1099 income, business income, rental income, or certain types of investment income, there are several ways to choose how you want your income to be taxed. For example, you could elect to have your income taxed as an S corporation, which is not subject to self-employment tax. And this can typically be a good idea if your business income is north of $50,000 to avoid some of that 15.3% extra self-employment tax. You can also elect to have your income taxed as a C corporation, which is subject to a flat 21% tax. This could greatly benefit someone in a 35 or 37% individual tax bracket and then who have plans to reinvest funds back into their business. Now, on the other hand, if you own real estate or tangible property, you can elect to take more depreciation against your properties to reduce your taxes. And this basically allows you to write off a portion of the price of that property each year. For example, most people write off less than 5% of their property value each year. But the tax code allows you to elect bonus depreciation, Section 179, and other forms of accelerated depreciation to write off up to 20 to 30% of those properties in one given year, which can offset a lot of taxes. There are even elections available for people who like to trade. For instance, day traders can qualify for trader status, which permits them to take additional tax write-offs against their investment gains. There's even something called the mark-to-market election, which allows traders to have all of their investment gains taxed as ordinary income. And these are just some of the elections and positions you can take on your tax return to pay less taxes. But there are even more things around choosing your accounting method, claiming various deductions, and more. But the bottom line here is that if you want to reduce your taxes without spending a lot of money, simply choosing how you want your income and expenses to be taxed can save you a lot of money in taxes. Tip number 3, qualify your expenses for Section 162 deductions. Now, I'll talk about this a lot on this channel, but this is again another thing you can do to pay less taxes without spending more money. So if you don't know this, Section 162 of the Internal Revenue Code allows you to write off all ordinary and necessary expenses paid or incurred for carrying on any trade or business. And people use this provision to write off portions of everyday expenses they may already have, like travel, vehicle expenses, dining, housing, childcare, and so much more, if and only if they can establish a business purpose for those expenses. And when you can generally write off the business usage of those expenses. For example, if you use 10% of your home exclusively for your business, then you can typically write off 10% of all of your home expenses under your trade or business. Or if you use 50% of your car for your business, then you can generally write off 50% of those car expenses, depending on the method you use to calculate your vehicle deduction. Now, my whole point here is that these are expenses you may already have and pay for, but with Section 162, you may be able to write off significant portions of those expenses on your tax return. And for the record, these are very basic deductions. There's far more that you can actually write off. For example, you can set up benefit plans under your business that could grant you more tax deductions for retirement plans, childcare reimbursements, medical expenses, and so much more. So if you want to learn more about that, just make sure you subscribe to our channel. Now, tip number 4 involves deferring your income. This is a very easy way to instantly reduce your taxes, because when we defer income, we're basically pushing money off of your tax return this year and choosing to have that income tax at some point in the future. For instance, when I put $1 of my own income into a tax deferred account, that is $1 that is tax deductible for tax purposes, therefore reducing my taxes in that tax year. And then in the future, when I withdraw those funds, I may be subject to tax at that time, ideally at a lower rate, or in some cases, I could even pull money out tax-free, depending on the structure that I use. For instance, an HSA allows you to do this for expenses that qualify. So let's walk through this. First of all, using tax deferred accounts is not for everyone. It's most commonly used for taxpayers who are in a 22% tax bracket or above and expect to be in a lower tax bracket when they retire. And secondly, there are many ways to defer income, but the most common structures include the following. Number 1, a traditional 401k plan, which allows you to defer up to $23,500 of your wages as an employee, or $31,000 if you are above the age of 50. Or if you're self-employed with no employees, you might use a solo 401k, which allows you to defer up to $70,000 or $77,500 if you're over the age of 50 and depending on your income. Or if you don't have access to a 401k at all, then you may choose to use a traditional IRA, which anyone can set up. And this allows you to defer up to $7,000 of your wages or $8,000 for those above the age of 50. And then there's my personal favorite to use, which is an HSA or health savings account, which allows you to put anywhere from $4,300 to $8,500 in it and receive a tax deduction, plus funds can come out tax-free when you use it for qualified health expenses. Now, ultimately, using plans like these can instantly reduce your taxes, and all of them typically have investment options, which you can then use to grow your wealth while saving for retirement or future health expenses, for example. For instance, someone in a 32% tax bracket would save almost $10,000 in taxes alone by deferring up to $30,000 of their income. Then they can turn around and invest that $30,000 and benefit from compound growth from their investments, which could result in that amount growing into hundreds of thousands of dollars in additional wealth. Now let's talk about tip number 5, making tax deductible investments. Now, outside of using tax deferred accounts, there are also several types of investments that you can make that can instantly reduce your tax liability for this tax year. Here are the most common ones. Number 1, rental property. Now, in addition to all of the tax write-offs we've talked about so far, due to the depreciation rules in the tax code, many real estate investors are able to take large amounts of depreciation expense to offset large portions of their income on their tax return. And number two, oil and gas investments. If you qualify as an accredited investor, then you can invest in oil and gas partnerships that conduct drilling operations. And many of those funds offer their investors anywhere from 70 to 85% of tax deductions against their investment due to several provisions available in the tax code. And then there's business investments. When you invest in a business, the expenses incurred by that business are now tax deductible and may help to reduce your taxable income. Plus, there are also specific tax provisions around things like research and development of new products and services and other credits that may grant you additional tax benefits. So usually when my clients' backs are against the wall and we're looking for more ways to save on taxes, these are the three primary areas we evaluate to see if we can create more tax savings for them. And in some cases, we might look at certain charitable giving strategies, but that may not apply to everyone in this video, so I will save that for another episode, so be sure to subscribe. If you enjoyed this video, make sure you click the like button to help this reach more people and drop a comment below. I sincerely appreciate your positive feedback. And if you need immediate assistance with reducing your taxes, just apply to work with one of my CPAs today at mycpacoach.com.